Chapter 19 of Openstax Principles of Finance pertains to the importance of trade credit and working capital in planning. Working capital describes the resources that are needed to meet the daily, weekly, and monthly operating cash flow needs of a business. The liquidity of a company hinges upon how well management plans and controls working capital. Current assets minus current liabilities equals net working capital. Working capital is a key measure of a company's liquidity. The goals of working capital management are to meet the operational needs of the company, to satisfy obligations or current liabilities as they come due, and maintain an optimal level of current assets. WC management is the effective control and operations of these current accounts. Current assets include cash and cash equivalents, marketable securities, accounts receivable, and inventory. Current liabilities include accounts payable, dividends payable, notes payable due within a year, current maturities of long-term debt, interest payable, income taxes payable, and accrued expenses. Measures of company liquidity include the current ratio, which is equal to current assets divided by current liabilities. The quick ratio or acid test is equal to current assets minus inventory all over current liabilities. And the cash ratio is cash plus marketable securities all over current liabilities. The cash cycle is the time between when a business begins production and acquires resources from its suppliers and when it receives cash from its customers. This is offset by the time it takes to pay suppliers, called the payables period. Working capital needs can vary. There's temporary and permanent working capital. Total working capital is composed of temporary working capital plus permanent working capital. More working capital is needed for high activity. The cash cycle is measured in days and is best understood by examining the formula. The cash cycle equals the inventory conversion period plus the receivables collection period minus the payables deferral period. In this example, the inventory conversion cycle is when you acquire the inventory, pay the trade credit, and sell the inventory, which is 36.5 days. The receivable conversion cycle, in this example, is when from the time you sell the inventory to collect the receivable, which is 54.7 days. The payable deferral cycle is the time before you acquire the inventory up until when you pay the trade credit, which is 34 days. The cash conversion cycle, then, is equal to 57.2 days, which is the time between when you pay the trade credit and collect the receivable. Trade credit is granted by vendors to credit with companies who are not required to pay immediately. Most trade credit is offered to customers on an open account that has a credit limit up to which the company can purchase goods or services without having to pay cash up front. As long as the payments are made in accordance with the terms of the agreement, credit terms, no interest or additional fees are charged on the credit balance except possibly for a late payment fee. Many vendors offer cash discounts to customers that pay their bill early. An invoice that specifies payment terms of 210 and 30, or 210 net 30, would allow a 2% discount if the buyer's account balance is paid within 10 days of invoice date. Otherwise, the net amount owed would be due in 30 days. The annual percentage rate of foregoing quick payment discounts can be estimated with the following formula. The APR of foregoing quick payment discounts is equal to 360 divided by full credit period minus discount period times the discount percentage divided by 100 minus the discount percentage. In international trade, two important documents are commonly required. A letter of credit is issued by a financial institution on behalf of the foreign buyer or the importer. The letter of credit secures a promise of payment to the seller or the exporter provided the terms of the sale are met. The bill of lading is a legal document that gives proof of a contract between a transportation company and the buyer. Cash management means efficiently collecting cash from customers and managing cash outflows. To manage cash, the cash budget is an important planning tool. Cash holdings. Companies hold cash for transactional needs, precautionary motive, speculative motive, and compensating balances. U.S. Treasury bills are obligations of the U.S. government with maturities of 3 and 6 months. Federal agency securities are obligations of federal government agencies such as the Federal Home Loan Bank and the Federal National Mortgage Association. Certificates of deposit are issued by banks, and they're a type of savings deposit that pays interest. Commercial paper is short-term promissory notes issued by large corporations with maturities ranging from a few days to a maximum of 270 days. Effective accounts receivable management is critical for cash flow and property planning for the long term. Management, or the credit manager, must distinguish between customers who have a high likelihood of paying and customers who have a low likelihood. Creditworthiness is judged by analyzing an evaluation of the customer's financial statements, financial ratios, and credit reports or credit scores based on a customer's payment history. If open credit is for a sales transaction, an agreement is made on the length of time credit is to be granted and a discount for early payment. Companies are free to establish credit terms, but most companies look to industry practices. Net terms usually range between 30 and 90 days. Inventory is a significant working capital component for many companies, such as manufacturers, wholesalers, and retailers. Inventory management involves management of the entire supply chain, sourcing, storing, and selling inventory. Essentially, inventory management is having the right amount of stock at the right place and at the right time while also minimizing the cost of inventory. There are four components to inventory cost. Purchasing costs are the invoice amount after discounts for inventory. It's the initial investment in inventory. Carrying costs are all costs of having inventory in stock, including storage costs such as a warehouse, insurance, inventory obsolescence and spoilage, and even the opportunity cost of the investment in inventory. Ordering costs are the cost of placing an order with a vendor, the cost of a purchase and managing the payment process. Stockout costs are an opportunity cost incurred when a customer order cannot be filled. It's lost revenue. From the sales budget, projections are made about cash receipts, how much each month's sales will be cash sales, and how much cash will be received from the collection of credit sales, including cash flow and from the prior month's sales. An operating expense budget is basically a prediction of the selling and administrative expenditures of the company. Cash outflows from purchases often do not equal the projected purchase amount. Payment purchases are usually on credit or accounts payable, so purchases from one month typically get spread over periods. Thanks for watching and listening. Be sure to like and subscribe.